Hello, dear students. So now we'll discuss the topic mutual funds for the smart investing. So first we'll understand the concept of mutual fund. So mutual fund is nothing but pooling the resources to build a diversified portfolio. So here, most of the investors they don't have the idea where to invest and how to invest. Most of the people they will be having enough fund with them, but they are not ready to take the high risk. So for them, they have an investment avenue called the mutual fund. Here, the financial institutions they appointed a fund manager. So the fund managers they will identify the investors who are having a same kind of mindset. Those many people they know how to invest. They studied a fundamental analysis or technical analysis. They can take their own decision where they can invest the money. But few of them they don't ready to invest directly and take the decision because they are not ready to take the risk from their side. They want the money very safe where they can invest and they want to diversify the risk to the third party. So that's why the financial institution they have a person fund manager. The fund manager will pull the money from different kind of people, those having a same mutual understanding. Right. So this is the concept where we are going to collect the money or pool the money, and the fund manager will identify different type of sources through the analysis, and then he will try to invest in different method so that they will try to identify different type of returns. Right. So here the image easily you can identify how the fund manager will collect the money from different type of investors. So the mechanism here, a trust that pools money from investors by issuing units, then invests that corpus into a wide cross sections of securities. Then the benefit what we will get by investment. So build in diversification by spreading investments across different industries. It ensures that because all stocks do not go in the same direction at the same time, and overall risk is significantly reduced. So when the fund manager they are diversifying the investment avenues, the risk will be reduced and the overall risk also will be very minimal when comparing with the other methods. So here they will go for portfolio management and they will invest in different category. So even if one avenue gives loss, they will get profit from the other avenues. So the regulated ecosystem built the protector investors. So during 1963, the Unit Trust of India established as the first mutual fund. And during the 1990s, public sector banks and institutions enter into the mutual fund space. And 1993 onwards, SEBI notifies regulations opening the market to private sector entities also. So the SEBI formulates policies and uniformly regulates all funds for public, private, and foreign. Its primary mandate is to protect investors' interest and mandate the transparent disclosures. So the structure check and balances of the fund. So first it will be the sponsor, the promoter who established the trust. And then it will come to the trustee. They hold the property for the benefit of unit holders and insured companies. It will be following the rule at least a two-thirds must be independent from the sponsors. And the trustee will be divided as a two category under the asset management company. It will be approved by SEBI to manage the funds and make investment decisions. So they are the person where they will pull the money from the individual investors and invest in different mutual funds, schemes or investment avenues. So here the rule will be 50% of AMC directors must be independent. Then the next one, custodian, a SEBI registered entity that physically holds the securities, ensuring the AMC and it cannot misappropriate assets. So what we are going to discuss net asset value. The analytics dashboard will shows you the metrics how we can identify. So net asset value is nothing but it will be the calculations of the assets minus liability and divided by the number of units. So the daily market price per unit at which you buy or sell, and we will consider maximum fee or the total expenses ratio. The annual fee charged by the asset management company for management and admin level and also the marketing. It will be charged to investors as a percentage of assets. A lower total expense ratio equals higher potential returns. And the other component will be the turnover ratio. It will be often the fund buys and sells stocks. High turnover means high trading cost, which can eat into returns. So when we are going to get the returns in future, The expenses also they will be reduced, and the remaining amount we will be get as a return. And major types of mutual funds, we will discuss about the open versus and closed-ended mutual fund. So here is the comparison based on the availability. The open-ended mutual fund, it is a continuous subscription, and the repurchase option also will be there. Anytime we can enter in this category of mutual fund. For closed-ended mutual fund, it's only available during the initial launch of your period. So when the closed-ended mutual fund methods is initially launched, only during that time, the investors can enter and they can start to invest. And based on the maturity period, the open-ended mutual fund schemes will be having no maturity periods. And closed-ended fixed maturity minimum it will be 5 to 7 years. And the liquidity then exits from these two schemes. Open-ended will be having high liquidity. Anytime you can buy or sell and daily at based on the net asset value. But closed-ended, it's listed on stock exchanges for trading or occasionally offer periodic repurchase at net asset value to provide an exit rate. So other types we will discuss in the upcoming videos. Thank you.